Okay, we're going to talk about some of the numbers for our 2011 analysis that we ran for our farms. We'll go over the numbers. You guys can ask questions. We'll just do this informally. We'll start with the whole state farm comparison. Our net farm income trend over the last 14 years, this is from 1997 to 2011. You can kind of see how it's gone up pretty sharp in the last 2 to 3 years. Way back in 02, I think was, what was it, 14,000 or something like that. It wasn't very much. In 2011, we saw a 46% increase over 2010. Obviously, we had good yields last year in most areas, had good prices. Livestock was actually pretty decent last year on all facets, so a combination of all that just added up to some pretty good numbers last year. The 2011 net farm income based on the age of operator, it's always kind of neat to see where they're at. The all farms you can see there in the first column. Actually, our 41 to 50 age range was the highest. They were over $500,000 net farm income. But even all of them, I mean, the lowest one is, well, right there at the less than 31 and the over 60. They're still about $350,000 in net farm income. So there's still a lot of good incomes out there, no matter how you look at it. The 2011 net farm income by gross farm income, we range it 100,000 to 250,000, 250 to 500, 500 to a million, and over a million. Obviously, the over a millions did very well. I think we totaled 10 farms had net farm incomes over $1 million. So obviously they were very large farms, but we did have 10 farms that net farm income was over $1 million.
How many are your averages?
112.
That's up.
So 10% of them were over $1 million.
Mm-hmm. Yep. We'll kind of go through some of the demographics here. You can see we have 112 farms. We base those on category, and like a crop farm would have, is it 70% or 80% of their farm income is from crop sales? 70%. So the dairy, 70% of their sales would be from dairy sales. Hog, same way. So if they're crop and dairy, then 70% of their income is from crop and dairy combined. So you can see, obviously, we have a lot of crop farms, followed by crop and beef would be the next biggest one. Gross farm incomes on all farms, we had 3 that grossed less than 100,000. And we had 37 that grossed over $1 million. The 44 and the 500 to $1 million range was our biggest area. Age of operator, we have 7 less than 31, 19, 31 to 40, 23, 41 to 50, 31, 51 to 60, and 32 over 60. So obviously we tend to be on the higher or upper age as far as where our numbers come from, but we're getting more in that 31 to 40 range, and we've gotten a lot of kids out of high school or out of college going back to school that we're starting to get. So that, I think that less than 31 has grown too, probably as opposed to the 7. I would guess it wasn't.
We've been fairly consistent in that range for a while.
If you look at the demographic for the debt to asset ratio, less than 20% debt to asset ratio, there's 45 farms. Over 80% debt to asset, there's only 2, so there's a couple up there pretty high, but for the most part they're on the lower end of that.
What kind of farms were they, do you know?
I don't know on that day.
I don't remember who it.
I would guess one of them is a hog farm and one of them is a cow-calf farm, if I just guessed from what I know. But that's traditionally the ones that have been there. One thing that we did change this year that affects the debt to asset ratio, and shifted that down, because that's a pretty different than what we saw last year. And then we did a one-time adjustment to land values, not to $10,000 an acre, but to something more reasonable than what we had them at cost. And so that does affect debt to asset, because debt stayed the same and their asset values jumped. So there is an adjustment there that we need to be aware of, and we make that, we don't plan to do that again for a while. But
we had a lot of farms at $1,000 an acre farmland that wasn't reasonable.
Yeah, so it wasn't giving them a practical balance sheet.
If we look at farm profitability, we can kind of look at where our gross farm income comes from. 34% of the income came from corn sales, followed by 20% on soybeans, 15%. You can kind of see how the income broke out there. If you look over on the right-hand side, the crop sales, there was almost $700,000 average crop sales. The crop inventory change, the average inventory change went up by $128,000 just on inventory values, whether that was more bushels or more price or a combination of both. Livestock sales was 284,000, and the inventory change on livestock was 26,000. Government payments averaged about 26,000, and then they kind of, there's other things there. The hedge gain or loss on hedging accounts was some pretty big losses on hedge accounts this year.
Yeah.
If you look at expenses and how that's broke out, that's kind of all over the board. The biggest one would be probably the feeder livestock purchase is 10%. It's probably the biggest one.
Well,
Seed is 9%.
13%.
Fertilizer's 13. Purchase feed was 14. Cash operating expenses total were 765,000 average.
On depreciation, there's no section 179 in that, or is that limited to 25,000?
No, we changed that this year as well and went to a 10% depreciation on the market side, and just totally did away with tax depreciation on a cost basis. So we just, the depreciation had gotten so crazy, we just dropped the tax stuff and went with a cost depreciation, or a managerial, is that what they call it?
Yeah, it is. So you can see the net farm income there for 2011 was $417,000 net farm income. If we look at the ratios, kind of small there, but the current ratio average was 2.69. Working capital is almost $608,000 of working capital, which is essentially what you have to start operating on at the beginning of the year, whether that's in inventory or cash.
Considering our average gross income now is 1.2 though, that's not, I mean, working capital is a lot, but it's not that much compared to what they're dealing with. So.
50% is really, really good for working capital, isn't it?
I think we have a trend on that. But.
You can kind of look through some of the numbers there. Some of the other ones, debt to asset ratio is 22%. Farm return on assets, 18%. That EBITDA, that's earnings before interest, depreciation, taxes, and amortization. That's 505,000. I still don't know what that number means for sure. It's a new number.
It mostly means how much cash you have left to pay things, because they take out all the non-cash costs. So that's how much cash you would have left to pay debt.
The capital debt repayment capacity is 388,000. Term debt coverage is 7.18. Your asset turnover rate is 50%. Operating expense ratio is almost 60%. If you look at the net farm income ratio, it's 33%. We'll get into our efficient farms here in a little bit. When we first took the efficient farms, when we started doing that, way back in the early 2000s, we looked at farms that were consistently over 20% net farm income, and we were scratching to find some that were over 20% to get into that. And now our average is 33%, and we have a lot of those guys in the efficient ratios that are, those numbers would be flip-flop. They'd be at 60% almost on our net farm income ratio and 30% on operating expense ratio, some of the efficient guys. So those numbers have really, really flip-flopped on some of those. Net worth by debt to asset ratio, you can kind of see some of the net worth. If they have less than 20% debt to asset ratio, their net worth is just over $4 million net worth. What's that? Average. The 20 to 40% is right at over 2.5, and the 40 to 60% is still just under 2. You can kind of see what the net worths are based on where their debt to asset is.
Are we going to get into net worths more later, or what? I guess thinking of the estate taxes, do we have many people worth over 8 to 10 million?
I don't think so.
I think we're getting more all the time.
I don't think
But if
so.
you fully adjust your land.
If we fully adjusted the land, we're definitely in that
You'd have
issue.
more than that.
There's a lot of that issue out there.
Out of that 112,
I'd have to look.
we have a half a
And it's
dozen.
hard because we only half inflated the land, but I don't know, 10, 15% at least.
Yeah, we guess so. Working capital to gross income, you can kind of see that line from 2002. The working capital, it's up to almost that 50% ratio, to where back in 2002, which was not a great year by any means, was less than 20%. So in 10 years, it's increased by 20% or 30%. I can't add either. Rate of return on equity. That one, again, you would expect that. 2007 was actually a higher year, and I don't remember a lot of 2007.
Part of that actually might be the fact that we increased their equity, so the rate of return on equity is going to be pulled down by that higher land value too. So You know, there's always going to be it's like a new trend line starting now, but that might be why it's the same or close to the same as 2007, because in 2007 the assets that they had weren't worth as much.
What was the dip in 09?
We had a dip in net farm income in 09.
Huh. Operating expense ratio, that's consistently pretty steady line down. In 2002, it was about 80% operating expense, which means every dollar you took in, 80 cents was going to operating expenses. In 2011, we're all the way down to 60%. So 60 cents is going out, and they're basically 20 cents is going somewhere else, whether it's in their pocket or depreciation or interest. Family living numbers, these kind of get a little bit scary. The net farm income, we don't have a lot of off-farm wages that amount. I mean, there's a lot of people that work off-farm, but a lot of it's part-time work. And then also on the non-farm, not every one of the people, the 112 that we do, keeps consistent track of family living. So the numbers are less in the family living here, so they can be skewed a little bit more.
So, Tony, is this an average of those that do report it, or this?
Yeah, it's an average of those who do report. So those who don't report aren't coming in at zeros.
Yeah.
It's just an average of those who do report.
And I don't remember the number that do report. It's significantly lower. But the average total of non-farm net farm income, or non-farm income, is about $34,000 of non-farm income. If you look at the average family living, the average family size is about 3.3, and total cash family living expenses is $85,000 this year. That's food, medical, health insurance, you know, charitable donations, and then pretty much everything else, whether there's some education in there, gifts, your real estate taxes on your house, long-term care, and then just cash and vacations and that kind of stuff. If you look on the right-hand side, the income taxes is about $40,000. That'd be Social Security and income taxes paid. So that's a fairly significant number. I know we've had a lot of people pay a lot more than that, but that's where it averaged out. So total family living, including taxes and real estate purchases, etc., is $180,000 going to family living if you total all that in.
I did a little look back 10 years ago, and that 180,000 is 130,000 higher than 10 years ago. And 31,000 of that is taxes, so the taxes numbers has climbed considerably. 50,000 comes from the other non-farm investments. But for another 50,000 of that is just family living costs, cash out. I mean, there's been a lot of houses go up and things like that ends up in here. So, you know, I wanted to separate those things out, but 50,000 of it came just from cash family living costs.
So from 34 up to 50,000, no.
Yeah.
Yeah, 34 to 84 in 10 years.
In 10 years.
2.5 times.
Yeah, and I don't know that we have a chart. Yeah, if you look at, we do have the trend line here in a little bit. But that trend doesn't go down. You know, I mean, in all the years you've seen that, we don't see that trend line come down. So it'll be interesting to see if farm income drops off, if we can pull that down.
Non-farm expenses, you can kind of look, it's kind of hard to see on that graph, but the dark blue is just family living cash. That would be food, health insurance, all that, etc. The taxes is the next bracket up, and then other non-farm expenses would be like the real estate purchases and stuff. So you can kind of see how they stacked up year to year and the ones that are growing.
You can see how wide that other non-farm, or the other non-farm expenses has grown, as whether it's been real estate purchases, you know, with houses, or saving, you know, putting money away for savings or different things like that. But that's certainly become a place where money's been starting to go.
Here's a family living and taxes trend over the last 10 years. Way back in 2002, it was just above 40,000. Now we're clear up over that 120,000. And that's just the cash plus taxes, right? Mm-hmm. Medical expenses, obviously that's a big chunk of their cost, or at least one that people think is. If you look at it in the whole, though, it may not be all that big as far as a percent. But the big one on the bottom, the darker blue, is medical, which would be your physician costs, chiropractor, eye doctor, that kind of stuff. The lighter blue on top is health insurance. You can see health insurance has taken a pretty significant increase, while the costs themselves may be your out-of-pocket costs, other than premiums, maybe haven't changed drastically. They've been kind of steady there. If we look at crop enterprise numbers, irrigated corn on cash rented land, we do have our average of all farms, and we have the top efficient farms in here. The yield wasn't that big of change. All farms was actually a little bit higher on yield. The top efficient farms did market a little bit better at 616 versus 604. So the gross returns actually was even, $1,180 an acre gross return. If you just look at the cost though, there's always actually fertilizer efficient farms were a little bit higher. The seed was about $10 an acre lower. Pretty close on chemicals, crop insurance. Irrigation was about $5 an acre difference. Essentially the same on cash rent and machinery. Your direct costs were a little bit higher on the full farm, but a little bit lower actually on the overhead costs. So if you look at gross expenses, they're actually fairly close too. The net return per acre was only about, what, $16 difference net return per acre. So there wasn't a real widespread.
Just 16.
The top efficient or what percent or?
It's 20, is it 20 farms?
22 of them, I think, now.
That are consistently.
And we picked those farms, several years ago.
It's not just top third, it's
the same 22 farms that have always been a little bit more efficient than the rest of the group. And those farms stay pretty steady unless, somebody retires or something like that. But no, that's the same set of groups, so it's not just the ones who did the best this year. So I don't think we've ever had the gross income quite that close before.
Yeah, that's really close. It's really on the expense side. And a lot of people ask us, what's the difference between top efficient? Well, there's no one thing that we can ever point out. It's just a few things here and there, and you can kind of see that, because some things they were higher and some things they were lower. But overall, it equaled out to $16 an acre difference on a 1,000-acre farm adds up.
On the one quick facts report that is top efficient, that says 2011 top efficient on the back. It's got some trends on the 4 major expense categories. And so you can see that it's just a little bit, some years they come fairly close. Usually, if there was 2009, seed cost was fairly close, but otherwise they're always cheaper. Fertilizer runs fairly close. A couple times they've been more expensive, but it's usually $1, $2 an acre on every expense that tends to put them ahead.
I'm amazed you're only at $180 an acre cash rent irrigated.
There's still a lot of
I
it.
always tell people we get actual numbers, not just what you hear about, because nobody's going to tell anybody about the rents that they're actually getting.
The cheap ones.
Nobody, they're out there. It's just nobody talks about them because.
I mean, there's always some of the family deals and that kind of stuff.
There's family deals. There's other non-related, good deals out there, but you don't hear about them because nobody's dumb enough to talk about them. They won't be there for long. So, but these are actual expenses that are put out there. So.
Dryland corn on cash rented. Bigger difference in income there. The yields were significantly different, and the price was a little bit more different. So you're looking at gross return per acre at $996 versus $884. So there's $112 an acre difference just in the gross return on this side to where it was even on the irrigated side of things. The expenses, seed was a lot closer here, but the fertilizer was a lot different, a lot higher on the top efficient farms, $20 an acre difference. Look down through the rest of them, crop insurance was a little bit lower on the top efficients and lower on the cash rents for the dry land. But you get down to the bottom, and again, we're about that, $120 an acre difference. So that one, a lot wider on the dry land.
Yeah, I would say from a demographic standpoint that the top efficient farms are spread out about similar regional area than as our whole state is. So it's not like we're pulling a whole bunch of farms from one county and putting them in that top efficient group. There's dryland farms in southeast Nebraska, and there's some up in the northeast, and there's some in the southeast, and I think we even there's some out of our western group as well. So they're pretty well scattered about at the same rate as our other group is.
If you look at irrigated soybeans on cash rent, net farm incomes, or the gross farm income's a little bit closer, not quite as close and even as the corn, but the dryland corn it's not as far a range as that. $742 an acre versus $716. The whole farm actually was less this time on the bean side of things. Look at the costs. There's $10 an acre difference in seed, $12 an acre difference in fertilizer. So they're a little bit higher. This one's kind of flip-flopped, but the net return equals out. What is there? $50 difference in net farm or net return per acre, and they beat it again. Or actually, they were a little bit lower. The top efficient didn't beat them in the soybeans. Dryland soybeans, they did beat them a little bit, a lot closer. When you get down to the net return per acre, it's 212 versus 213. So there's not much difference in that $1 an acre, almost a little over. So a lot closer on the dryland soybeans than cash rent land. 2011 crop trends, whole state. You can kind of see there, that first box on the top left hand is irrigated corn, all tenure types. Looks like we did a 5-year average. The bushels per acre, or the trend, the bushels per acre, our low year in that 5-year was 181 in 2007. It was only 192 in 2011. 2 years ago, we were at 207. So it wasn't our highest year on yields. The net returns, though, we are the highest on net returns. Our lowest was in 2009 at $60 an acre, even though we had the higher yields that year. But we're at $346 this year in 2011 net return. Irrigated soybeans, the next one over. You can see the range in bushels per acre there from 59 to 65. So there's not as big a range by any means on the crop or on the soybeans.
I think the one thing to look at is the increase in production costs in every category, and how high that's going up. Even though we had a high net farm income this year, cost production went up. Consider, like, look at soybeans, it's $1.10, or that's $2.10. Sorry, per bushel. Costs are going up, you know, and just continuing to
If you look at irrigated,
30% increase, isn't it, in 1 year?
yeah, if you look at irrigated seed corn, they went up $1.25. $1.20.
Yeah.
So even though we're making that much money, we're spending a lot more to get it.
When we put this together, I was surprised to see those cost production numbers be as high as they are.
They all went up significantly.
Yeah.
So you can kind of see the rest of them there. I won't go through all of them. If we look at our top efficient farms now, we can go through some of those numbers and kind of see where they're at. This is the net farm income over the years from top efficient farms versus the average farms. The darker line is all farms, which is always lower. It never did cross. The efficient farms are a little bit higher. Some years came pretty close. 2005 was real even. 2006 was pretty even. But there's been some pretty decent gaps. 2009, it widened out pretty decent there. That's the widest gap there was. But this year, there's a pretty significant gap again in net farm incomes, almost $100,000.
Yeah. I really thought in 2007, after watching 2005 and 2006 get so close, and then 2007 when the profitability really took off, I really thought we were going to see the top efficient farms be less, just because it seemed like it was a really good year for risk takers, and our top efficient farms tend not to be big, and they don't do a lot of cash renting, they don't do a lot of those things, and then they widen the gap every year, and so I was way wrong, but they continue to pull out and
She was wrong. She
I
admitted
said
it.
it once. It happens one time.
So if they're not cash renting ground, are they buying it all in?
Share
There's
rents.
a lot of share renting in that group. There's some cash renting in there, but
They tend to share rent more.
they tend to share rent more. They own some too, but it's not like they're out there buying the ground left and right.
One of our, yeah, he's in the top efficient. One of our biggest guys that's in the top efficient, he has one farm that's cash rent. Everything else is 50% cash rent or share rent.
Of like over 3,000 acres. He just has it all on a share rent basis.
I think that's there's areas where you're not going to get a rent any ground unless you pay cash rent.
Mm-hmm.
Because farm managers are driving that.
I'm surprised that this guy is because he's South Central area and seed corn irrigated
Seward
area.
County.
It's Seward County. And I was surprised that he has that many.
Mm-hmm.
He's almost all share rent and
In our
owned.
area, the farm managers are just driving everybody
Mm-hmm.
out on
Yeah, I believe
share
that.
rents.
Well, and right, I think if you look now, share rent hasn't been making as much money as as cash rent, which is funny that the farm managers haven't figured that out yet, but
We all, they're all looking for the sure dollars.
yeah, because on average, for
The way
irrigated
their-
corn,
Their contracts are set up, it's really beneficial for
for
the
them,
land managers.
on average, our producers made $140 or $130 more on cash rent per acre than they did on share rent. And up until about 2007, share rent always beat cash rent. So,
Well, this year could be a dramatic difference too, with the price drop, share rent's gonna look
you
better.
mean
isn't it?
2012?
Yeah.
You know, it all depends on, you know, how soon things were, yeah, I mean, there's gonna be a lot of variety. In a year when we see price fluctuation like that, we see a lot of variety, because there's those who took advantage of early marketing opportunities and those who didn't. Yeah, and so, you know, we'll see a huge range in average marketing prices when we sit down and look at things.
We can look at our net farm income as a percent of gross income. All farms is the bottom line again, the darker one. So you can kind of see what their net farm income as a percent of gross. So the whole farms, or all farms, are about 32%, 33%. The top efficient farms is just about 45%. So there's a pretty good difference there as far as what they're, as a percent of their gross. So they're getting close to 50% of their gross they're keeping.
If I, average gross income is within it's within $60,000. So, excuse me, when we first started this group, the top efficient gross income was considerably lower, but they've come up and matched that now.
Top efficient farms as far as profitability. Gross farm income comparison, average farms versus top farms. So the gross farm incomes are pretty close. You can see in last year was dead even, and even in 2009 was pretty dead even. Spread just a little bit in 11 as far as gross incomes, but they're close. There's not a big size difference between our efficient and our average. Top efficient income statement. Crop sales, our average crop sales was higher. I don't think there's a lot of livestock in our top efficient guys, if very little, and most of it's a few cow-calf if there is. But you can kind of see gross livestock income, there's 310,000 versus 33,000, so there's not very much livestock in our top efficient guys.
One of the reasons for that is the way our program calculates net farm income ratio is it includes feeder livestock purchases as an expense. And so a livestock operation, especially a feeding livestock operation, is not going to have the same kind of net income ratio because they have that major expense. If we use that expense as a negative income, instead their net farm income ratio would be a little bit more comparable. And when we first started looking at this, we tried to do that by hand, but realized there was no way we could get to averages with that. So it's not to say that there can't be efficient livestock operations. It just doesn't fit into the way we set this study up. So.
You can kind of look down through some of the incomes and that kind of stuff. Government payments are a little bit higher on our average farms. Change in accounts receivable was significantly higher. They did lose more on hedging accounts. Cash operating expenses, if you get down to the expenses, 765 versus 567. Depreciation was higher by about $15,000. Their interest was a little bit less. You get down to the bottom, your net farm income is right at $100,000 difference between our whole farms and the top efficient farms. The financial ratios on our top efficient, the first column there, a little hard to read, but it says average of all farms. The second column is the top efficient. So the current ratio is 2.69 versus 3.84. Working capital 607 versus 846. So they've got 71% versus 51% or 50%. So they've almost got 25% better. Debt to asset ratio is 22 versus 14. If we go over on the other side, capital debt repayment capacity, 388,000 to 508,000. Replacement margin 305 to 416. If you get down to the operating expense ratios, there's where you see about a 13% difference, 59% operating versus 46% operating. Depreciation's a little bit higher on our average farms, or the top efficient farms. The interest is almost dead even there, and about that 10% difference in net farm income ratio. They're just a little bit tighter with it and hanging on to it. Operating and interest ratio comparisons. You can kind of see those numbers there. The gap's been essentially the same every year. It's just up and down. When one's up, they're both up. The interest expense ratio, you can see how much interest has come down. A lot. But they've come down.
The top efficient group's been pretty steady though. They just haven't changed.
The whole farms have come down pretty significantly. Family living numbers. Again, the first one is all farms. The second column is efficient farms. If you get down to the end, there's 85,000 versus 77,000. So they're not a whole lot more efficient in the family living, but they are a little bit more again. But when you figure in, the income taxes, their income taxes actually are about the same, but they tend to have a little bit more. They've done a little bit more personal real estate purchases, which they probably built houses, and a lot more in savings is where the big one is. So they actually are higher in that, but some of that's going to savings. Almost $200,000 of family living expense, whether that's savings or land purchases or out-of-pocket expenses.
I'm amazed the income taxes aren't higher. A few years ago, 40 was a lot, and anymore 40 is nothing.
40's average.
Here's the enterprise trends. This is seed cost on irrigated corn on owned land, average versus all top efficient. The dark one is the all farms. So you can see the all farms has a higher cost of seed per acre. Almost $100 on all farms, and they're down to just over 60 on the efficient farms.
What are efficient farms doing the last 2 years to hold that in check?
I don't know.
I know a couple of them. I don't know. I don't know if they're going with a cheaper company. I don't think their focus, is as much on the highest gross income possible as it is on the highest net income. So they're not necessarily going to go out there and buy the very best seed that can get the very best yield. I know some of them in conversations, will go with a cheaper seed that'll get them a good yield rather than a really expensive seed that'll get them a great yield. So I know some of them have that philosophy.
The other thing that's happening out there is equipment, and with so much of the precision ag stuff, planters today don't overplant, and turn rows or things like that, and sprayers that are set up so they automatically shut off those sections, and those people are saving seed bushels, and they're in chemicals. My brother-in-law bought a sprayer like that 2 years ago, and he was just amazed at how much less herbicides he used that year. And I didn't think the investment was worth it, but then after I visit with him, it starts to make sense.
So it might sow some precision ag.
It could be that.
Unit controls would show the machinery.
Since we don't have any way to track quantities of how much seed was put per acre, how much fertilizer was applied per acre, it's really hard to know that. Whether it's a purchasing decision or an application problem or an issue or what it is exactly that does it. We just see it consistently.
I talked to a guy a year ago that put the shutoffs on, I think, every 2 rows on his planter, and I think he was only on 12 or 16. It was just amazing when you get done with the field how much is in the end boxes compared to the middle boxes, because they're shutting off so much sooner. He goes, you'll have a half a box full on the end rows and you'll be almost empty on the middle. He goes, it's huge.
Another thing that's kind of interesting in this, I know I've got several sets of brothers where one's in the top efficient, one's not. But they buy all their inputs together, and they share a lot of equipment. And so they manage to do it on the other issues. But there's multiple examples of those brothers that one's in the group and one's not, when they share so many things. And so it's interesting to see for sure why that is, because their seed cost should be the same.
just coding their checks different.
Maybe that's.
They're coding their checks different.
Or maybe it's the one who's calculating with the seed split that's in the official.
The fertilizer costs, they've actually kind of crisscrossed a couple years there. But the all farms is actually a little bit higher on fertilizer costs again. Last year it was flip-flop. That was the first year. The 2005, 6, and 7 were pretty even. Even 8 and 9 were pretty even. Wider gap this year. It's probably the widest gap there's been on fertilizer. Chemical costs, they've kind of crossed a couple times there. Again, the last 2 years have been a pretty wide gap on chemical costs. Quite a bit more efficient by about, what is that, a little over $10 an acre. Crop insurance are pretty even. I don't think there is a big difference in cost if you get carried away with what you want to protect, but they're fairly even. And again, they've crisscrossed a couple of times too, so. But about dead even this year. Go through a little bit of the regional comparisons. You can kind of see how we have, I mean, the lines aren't in here on how we break it down, but the way we break down our regions is, it's a fairly easy pick between southeast, northeast. The south central area is kind of your irrigated seed corn acre land between probably Seward County to, I think it goes out to Kearney, somewhere in there. Maybe not quite Kearney. But then pretty much everything west of there is all in the western, and the only reason we can't split that up anymore is because we have a low number of people out there. We don't have that many to split it up anymore. So the western area is a huge area of Nebraska, just not that many farms in it, because it's still the smallest region, isn't it? Even though it's the biggest area. So here's your state regional comparisons. Crop income, highest crop income in South Central, which makes sense because there's quite a few seed corn acres in there. Not a lot of cow-calf or any other thing. Livestock income, the western is the biggest there, which makes sense. You're getting the feedlots up north. A lot of cow-calf in the sandhills, even a lot of the cow-calf out in the southwest part of the state. So gross cash farm income, they're actually not a huge, I mean, there's $500,000 range from 975. Actually, South Central is the lowest gross cash farm income, which I guess I'm kind of surprised a little bit by that. But the western's the highest at 1.5. But again, you've got some of the bigger feedlots and cow-calf in there. If you look at expenses, net cash farm expense, the highest is South Central. The lowest is the western.
That's net cash farm income.
Or net cash farm income, I'm sorry.
Oh, no, it's still that way.
But the accrual net farm income, highest in South Central at 459, down to 355 in Western. So they were all still very, very good because 355 was still higher than our average last year. But only 2 of them were below the whole farm average, in the Northeast and the Western. Kind of a breakdown southeast. This just expands a little bit on the last page. The Northeast, the Western, and the South Central. Net farm income regional comparisons, you can kind of see the trends for the last 10 years on what each of the regions has done. Southeast has done significantly good the last 3 years compared to what they were in 08. Had a pretty good peak in Northeast in 07, but have beat that again the last 2 years. Net farm income in Western, that's probably been our biggest one. I don't think we had any years that were negative. I thought there was a year that
2002.
Is that negative? Oh, it is. I'm sorry. 2002 was actually negative out there. Was the only year we had negative on any of the regions. So you can kind of see what Western's done. It's been a good year the last 2 years out there.
I think you can see that the recovery from the livestock, or at least from the beef producers in those last 2 years, and what the cattle or the calf prices have done for those Western producers. I guess that's our biggest difference there.
South Central's almost always been higher and significantly higher, but that kind of makes sense since you got the irrigation potential that there is there. Seed corn's been good to them. That's all we got.
When I put the book together, I pulled a couple of things just from looking back 10 years, and I decided I put them in the front of the book. But 10 years ago, our average gross income was $400,000, And this year on an accrual basis, it was 1.4 million. So we've had $1 million increase in gross income in 10 years. And so then I wanted to say, okay, well, let's check that out. So I went and looked at the total crop acres. In 2002, it was 937 on average, and it's 1,099. So it's 162 acres more now on average than it was 10 years ago. So we're not dealing with bigger farms, because that would have been my first thought. But I looked at the corn price then, and it was 208 in 2002, and our average was 537 last year. So that makes a big difference. Net farm income 10 years ago was 25,000, and now we're at 417. So that's big. This was the first year we broke $1,000 on average gross return on irrigated corn. So it's the first time our average income. It wasn't too long ago that one of our producers was trying to figure out any way they could make that gross income be over $500. They were double cropping wheat and soybeans, doing all these things. They figured they needed $500 in gross income to survive, and now we're averaging over 1,000. We talked about, and then the other thing, our average debt hit a record high at $800,000 this year. When I looked at that, and long-term debt did not increase, it actually dropped a little bit. All of that increase came from current intermediate debt, which to me, I think we're seeing a significant impact of tax deferral. You know, with our ability to write off equipment, we could finance that, pay for it later, write it off today. There's a lot of that happening. We're also seeing those operating notes increase because we're doing a lot of prepaying and a lot of holding of crop over to the next year. You know, so I really think that debt increase is becoming a tax deferral thing. It's just we have really cheap tax rates right now, so that could get to be an expensive choice if this profitability continues. I looked 10 years ago, our average crop and feed inventory was 120,000, and now it's 620,000. So we have $500,000 more inventory pushed off than we did 10 years ago.
So a lot of our working capital increase is just tax deferral. So a third of that, 30 to 40% of that doesn't exist by the time you pay the tax on it.
Mm-hmm.
So when do they pay the piper?
Yeah.
Next year.
Next year's always a good time.
Tina had a new client a couple of years ago that next year ended up to be this year, and he said, well, I always thought it was going to be next year. I didn't really think it had ever happened.
Tina, one of those challenges would be, I don't know how many of your operators actually retire in a given year, but they've deferred things for so long.
Mm-hmm.
Eventually in the year of retirement, there's no way to,
Yeah.
there's no good way to transition around
Yeah. We don't have, nobody retires. So, I also looked 10 years ago, the average dollars invested in an acre of corn was $358, and it's $717 this year. So,
An example of that retirement, though, in a way, though, is Tina got one that came to her this year, and the husband died in what year?
March.
Of 10.
March of 11.
Of 11. He had sold all his corn and carried
Before he died.
Before he died, and prepaid everything the year before.
her tax bill was like
Oh, my.
So, anyway. Yeah.
I read an article about, this capital gains tax thing in 2013,
Mm-hmm.
reverting, that if you sell land or the capital gains in 2013, you also have to pay in Medicare.
It's a different tax. It's the same as Medicare. It's a 2.9% tax on because they like you.
It's because it's triggered by a non-farm income being at a certain level. It's
I
not
thought just
everybody.
any income.
$250,000 worth of, for a married family, is $250,000.
Yeah, so there was a trigger for it because it was just for high income.
Yeah.
Yeah, they're attempting to go after the high income people to pay additional tax to help support the healthcare costs. That's what it's for. So if it's just the capital gain, I don't think that triggers it, but I'm not certain on that because
I think you're right. It's just anything over the $250,000. And because I read, even if you sell your house, it's not a taxable event, but if that would put you over that 250,000, you're gonna pay a 3.8% tax on part of that sale of your house.
But it was part of the healthcare bill, so if that gets knocked down, then it'll go, so.
Yeah.
Because, yeah, that one's, there are, I believe, 3 different taxes that are, two or 3 different taxes that if the Supreme Court knocks the health bill down, they will go away. I mean, because they were put in specifically to pay for the additional healthcare costs that the government would be picking up.
And this year, maximum capital gains is 15%. Does that go to 18 or 20 next year?
It's at 20, but unless it's qualified long-term, right? Okay, something like
I
that.
get confused on it. As if it's over 5 years, then it's 18?
I think that's
so.
what it is.
Okay, so it'll go to 18 plus your other 3, so you're going from 15 to 21 at a minimum. Maybe 24%. Which is about a 50% increase in the amount of tax you pay.
Just gonna sell my farm.
Yeah.
Oh, there's
Any other questions or comments?
That hedging, 11,000. Nobody made any money hedging.
There was some people that did, but there was some really big losses.
I don't know how you could hit it. You had to be lucky.
Yeah.
Yeah, I think in 2010, I don't think we had anybody that had a hedge gain. In 2011, there were some, but it still averaged out as a loss.
It's been about the last 2 years been running that way.
Yeah,
Mm-hmm.
By ugly, you talking 100,000?
we had more than that. Some of them. But, you know, if you think about how many acres you're covering, you know, and
Well, that, and then if it's a hedge, you didn't lose it.
right.
Correct.